Hello traders, welcome to a new start of the week video. Recording this on Monday the 12th of August. Looking at the rotational patterns of the sectors on a weekly chart, so not too short of a time span, but decent trends, I would say. We can see that the rotation out of technology is still ongoing. That's the most important observation from a relative rotation graph at the moment. It's also the only sector that is still inside the lagging quadrant, despite its weak heading between 180 and 270. But what I want to concentrate on is what other sectors are doing. If you look at the last few days, the market has been holding up pretty well. We've seen some sort of a recovery rally, and we need to identify whether it is indeed a recovery rally, which would mean that there is more downside to come, or whether we have completed our corrective move and will be moving higher. I'll try to get into that a little bit later, but if you look at it from a sector perspective, it's still the rotation out of technology. And this RRG, as you know, has the bubbles which indicate the beta, and the bigger the open bubbles, the lower the beta, so the more defensive the sector is. And there's a few which you would expect, like healthcare, staples, utilities. These are big open bubbles. But also materials apparently is a low beta sector, and so is energy, although I would probably put them in a more market sensitive offensive group, but this is what the data tells us. Anyway, the what you see here is that utilities came down, but if you look at the rotation over the last 2 weeks, you see it's a little bit static. So it didn't really continue its decline. It's now static, and you can see how consumer staples has sharply hooked back up. And healthcare is definitely increasing its velocity. So the distance between the nodes is increasing. And that is interesting. So the sectors to watch for buying opportunities, if you wish, or, if the market goes down less, if the market goes down, these are the sectors where you would expect the stocks to go down less than the market. So a defensive perspective, then healthcare and staples would definitely be on your list. Just as a side note, if you look at the difference between, for example, healthcare and consumer discretionary, here you can see how the distance between those nodes is decreasing. For healthcare, and to a lesser degree staples, that distance is increasing. So for healthcare and for staples, there is power behind the move. For consumer discretionary, the move is slowing down, and you saw that last week where the last node was very close to the previous node and did not pick up relative momentum anymore. So the odds for the consumer discretionary sector to roll over while inside the improving quadrant are increasing. If I zoom in on the industries inside the healthcare sector, then you can see that all these groups are now at a positive RRG heading versus the S&P 500. And that is despite the recent weakness in the market. Remember, this is also a weekly RRG. And if I scroll back through time, then you can see that there's been quite a bit of negative rotation for most of these sectors. This is the end of 2023. And then you rotate into 2024, and you see a lot of red tails. These are the RRG trend bars, as you know. And you see that they continue to be red through that rotation. Small pickup in healthcare equipment, but then it rapidly declines again. And then here, this is in May, then mid-May. Everything is going into the red, into underperformance, relative downtrends versus the S&P 500. And when we slowly move forward, that continues to happen during June and also part of July, and then it starts to pick up. So here we are at the end of July, and we're now starting to pick up. And that has been improving and increasing over the last couple of weeks. And we now have all these groups at positive RRG headings, led by, I'm going to say, technology and pharmaceuticals. Also, that's the second in line if you just look at the RS ratio metric. And then followed by healthcare providers and services. These are still inside the lagging quadrant. And then you see healthcare technology picking up. Now, if we bring up the chart, for example, for the biotech and the pharma industries, and here is the biotech chart, then you can see that after the break above this horizontal resistance area around 4350, 4400, after that break above, so this was the ultimate high, was 4405, 4410, that industry has held up very well, and it actually managed to turn around the negative trend bars into improving, and now the last one is actually green. It's pushing into the leading quadrant here, and you can see the improvement in the RRG lines. So despite the weakness that we've seen over the last couple of weeks in the market, this sector actually picked up. So if you're looking for buying opportunities, then the biotech industry inside the healthcare sector is definitely worth an additional look, I would say. And then another group that might deserve a little bit more of our attention is pharmaceuticals. Here also, you see the break and you see the old resistance tested as support and then a follow-up rally. But this all happened while the S&P, or more precisely semiconductors and the technology sector as a whole, were rallying much faster. That's why these bars turn red, because other areas in the market were doing better. But what you see now is that money is rotating out of the technology sector. This sector is holding up very well. And you see a very nice big reversal bar here last week, where we actually closed very, very near to the high of the week, well above the old resistance area, which was tested as support. Probably going to put in a higher low there, and you can see the improvement in the RRG lines. So even despite the pressure that you may see in other areas of the market, and even if that spills over to the market as a whole, it looks as if the biotech and pharmaceuticals groups inside the healthcare sector could actually provide some nice out-of-the-box opportunities for us as traders. And if I finally take a quick jab at the chart of the S&P 500, this is a daily chart. Everybody's watching that very closely. I think that the current rally out of the recent low here is pretty crucial and will give us a lot of information on how the next weeks will pan out in terms of S&P performance. I'm using a very, very, simple, plain vanilla approach, lower highs, lower lows. So that's a downtrend. And all support returns as resistance. So what happened is that we bounced at the top of that gap area that happened here on July 25th. We rallied. Then we've got that massive decline in 3 days that brings us all the way down here, which was confirming the lower highs, lower lows. And now we are in a rally that is now underway for 5 days, and it's nearing the resistance area. So the old support area here between, I'm rounding it off, 5370 and 5400. This is where I expect new pressure to come in. If that happens and we put in a new high in this area, then the next decline is probably going to challenge the previous low, and if it breaks, we're going to go much further. In any case, it looks as if the coming week will be pretty crucial in terms of what to expect in the weeks after that. So we'll continue to monitor that for you closely and keep you updated, and I'm looking forward to seeing you again next week, same time, same place.
Hi, it's Todd from tradinganalysis.com. Thanks so much for watching. Listen, my team and I have so much to share with you in terms of our technical analysis, our fundamental analysis, portfolio management tactics, trading in and out, maybe options, sector rotation. Let us know what's most interesting to you. Maybe drop that in the comments section and we'll do our best to work it in. Also, consider clicking the subscribe button and the bell icon to be notified when we put out new videos. And finally, you can check us out at tradinganalysis.com if you'd like to see us manage our real portfolios in real time. Thanks again for watching.